Today we're going to talk about the role of the individual investor in the stock market. That may be you and me. And it's become more commonly said that the individual investor really doesn't have a role in the market anymore. With computerized trading and flash trading and hedge funds employing teams of PhDs, how can the individual investor possibly compete? And the surprising result that I'm going to tell you today is the individual investor can not only compete, but on average, the individual investor will do better than these active investors who are spending all the money on computers and PhDs. Now, that may seem impossible, but it's not only possible, it's an arithmetic fact. And the work to demonstrate this was done in the early 1990s by Professor Bill Sharpe, who is both the Nobel Prize winner and the father of the capital asset pricing model. And Professor Sharpe is a very clever guy, but the example he's come up with is remarkably simple and incredibly powerful. So I'm going to take you through it today in the simplest possible case, where there are two types of investors. Passive investors who simply accept the market and buy an index fund that mirrors the market. And everybody else, the active investors, the hedge funds, the computer traders, the specialized pension funds, and so forth. And I'm going to show you that on average, those passive individual investors always do better. And it follows very simply from Professor Sharpe's basic market arithmetic. So let's get to it. So let's assume that this entire blue circle represents the entire stock market. It includes all investors. And as I said in the introduction, I'm going to make this simple. I'm going to divide it into two groups. The first group are the passive investors. And let's assume that most individual investors recognize their limitations and put themselves in that group. What do I mean by passive? I mean there are indexes that are designed simply to mirror the market. They hold basically the market portfolio. And because there's no judgment involved in holding the whole market, they can do this very, very cheaply, basically for free. So to keep it simple, let's assume that you can buy the whole market for free, or buy a portfolio that mimics the market, and it passively follows it. So that's the passive. Now the active is everybody else. That includes the hedge funds, that includes the computer traders, that includes the sophisticated pension funds, and so forth. These are people who are engaged in trying to figure out ways to beat the market one way or another. So those are the two parts, and everyone fits in one or the other. Now let's assume that in a particular year, say 2012, hypothetically, the market is up 10%. Well, if the market is up 10%, and if the passive investors are holding a portfolio that is designed to just mirror the market, then the passive investors have to be up 10% as well. But if the whole market, the entire circle, is up 10%, and if the passive part is up 10%, then the active part, which is all else there is to make the whole, has to be up 10%. If it weren't, then the active and the passive put together wouldn't be up 10%. So the active has to be up 10%, but that's on a gross basis. That's before they pay for the computers and the PhDs and the expensive money managers and the marketing to sell you their services. So on an after expense basis, the active group as a whole has to be up less than 10% because they have to pay for their expenses. So what have we learned? The small passive investors on average must, and this is not, there's no ifs, ands, or buts about it, must outperform the active investors after expenses every single year. Now when I tell people this, when I show them Professor Sharpe's arithmetic, they say, how can that be possible? Well, what they're thinking is within the active investors, there are some that do very well, much better than 10%, but there's got to be even more that do very poorly, much worse than 10%. So the only risk to the small investor is not entering the market, but it's deciding to be active and to try to beat the market. If that investor tries to beat the market, he or she is likely to end up being one of the actives that does worse than 10%. But if they're willing to accept their limitations and accept what the market gives, on average, every single year, they're going to outperform the active investors. So the bottom line of this is that not only does the small investor not have to worry about all the sophisticated new trading, nor does the small investor have to worry about being in the market. What the small investor has to worry about is being sucked into active trading, which could be a disaster. So in future sessions, we'll talk about what the small investor can expect if they follow this passive strategy. But holding stocks generally is not a bad idea for small investors. In fact, it's a very good one.